Good morning, everybody. My name is Bob Parker and I chair AMIC, and I'd like to welcome you to our webinar today on digitization and the asset management industry. Now, before we go into our agenda, just to highlight, we have two panels today, and also we have one presentation from Matthias Levine from the European Commission on the work that they are doing. So that's my brief introduction. Now let me just pass you please to Martin Scheck, who is the Chief Executive of ICMA.
Well, thank you very much, Bob, and thank you as ever for all your support to make AMIC such a vibrant committee. And good morning to all of you. It's really a great pleasure to welcome you all to today's first AMIC FinTech virtual event on the impact of digitization on the asset management industry, as we've just heard from Bob. Now, as you know, our main mission at ICMA is to make the international securities markets operate as effectively as possible. We have over 600 members. They're based in 62 different countries, and the membership is extremely broad. It includes issuers, it includes intermediaries, it includes market infrastructure providers, and of course, it includes investors of all stripes from all over the globe, whether that's asset managers, it's asset owners, SWS, central banks, and a swathe of private banks as well. Our philosophy at ICMA is to be inclusive. We want to involve the full value chain in the committees and councils that deal with our four core areas: the primary markets, the secondary markets, the repo and collateral markets, as well as sustainable finance. And it is generally the case that both buy and sell side members are included. But there are certain topics specific to our buy side members which are looked at primarily through an investor lens. And this is where the AMIC, our Asset Management Investors Council, really comes into its own as a representative body for the buy side. Within our core areas, we have a number of cross-cutting themes, and there are currently two dominant global themes, and I think neither of these will be a surprise to any of you. The first one, of course, is sustainability. It's impossible to have any discussion without talking about sustainability. But the second one, and the subject of today's discussions, that's FinTech. And ICMA's work on FinTech is guided by a cross-industry advisory committee, and this includes mapping directories of FinTech solutions. It includes regulatory interaction. It includes participation in official sector FinTech groups. And of course, information exchange at fora such as today's and within our councils and committees is an incredibly important aspect of our work. Of particular interest to ICMA are standardization and digitization of relevant data. Tokenization is a topic, and the regulatory environment for FinTech and innovation generally. And in the context of standardization and digitization, you may have seen one of our major current initiatives, which is called the Common Domain Model, or CDM, for repo and bond transactions. We're just approaching the end of the first phase of this project, and this digitizes the life cycle events of repo, of collateral, and cash bonds into a central repository. And this will allow market participants to use the CDM as a common language to process repo and bond transactions instead of relying on their own unique set of representations for events and processes. We expect this to create, over time, industry-wide efficiency gains, interoperability with related products, and it will form a foundation, a basis for further market digitization. Now, the FinTech agenda is of immense interest to AMIC. That's clear. It's clear that the depth and the digital capabilities of asset managers is exceptionally wide-ranging, from process automation to cutting-edge artificial intelligence. And today, we'll be looking at the impact of digitization and tokenization and the use of artificial intelligence. There is no question that developments in these areas will lead to greater process efficiency, generating cost savings. But more than that, they'll transform decision-making, they'll redesign the overall market structure, and they will increase the investability and accessibility of alternative and perhaps entirely new asset classes. AMIC is a useful forum for buy-side members to discuss the deployment of these solutions, and we hope that today's AMIC conference will provide information. It should provide food for thought about future developments and mark a step forward in our understanding of how fintech can be applied to the asset management world. We're very grateful to the speakers, to the panelists for their contribution today. Thank you all very much for taking your time to support us. So with that concludes my opening remarks, my few opening remarks. I do hope, very much hope, that you find today's discussions interesting. We're looking forward to fielding many questions. And now it's my pleasure to hand back to Arthur Carabia from ICMA.
Thanks, Martin, and good morning, everybody. Welcome to our first panel named Tokenization, Opening Up Alternative Assets to Investors. My name is Arthur Carabia. I'm a director at ICMA, where I look after our buy-side community, AMIC. I will be your moderator for the first panel. I'm joined today by three excellent panelists. We have first Emmanuel Pesinicic, Head of Digital Strategy and Head of Digital Asia Pacific at BNP Paribas Asset Management. Emmanuel is also co-chair of the Blockchain Committee at the FinTech Association of Hong Kong. We then have Ayota Nasser, economist and policy analyst at OECD. And finally, we have Stéphane Janin, Head of Global Regulatory Development at AXA Investment Managers. He's also Vice Chair of AMIC. Welcome to the three of you. Maybe to kick off the conversation, I'd like to turn to Emmanuel and ask her if she could maybe remind us what do we mean by tokenization, and generally speaking, why is it of interest to the buy side?
Sure. Thanks, Arthur. So basically, just for us to be, aligned in terms of knowledge, we thought that it would be good to have a quick definition of what is blockchain and tokenization. So basically, the blockchain, you need to put it really simply, it's a database that is, can be perceived as a ledger that is spread across a network, and all participants of those networks are called nodes. All the transactions are recorded simultaneously, across all those nodes without a centralized administrator. So that is the main definition of the blockchain. So then there are multiple characteristics. The first one is that it's timestamped in a sense that each transaction is basically timestamped, and we can have a proper audit trail of this transaction. It's programmable in a sense that there is in some of the blockchain, the smart contract technology that enables, automation inside those transactions. It's distributed, as I explained. All the nodes on the network are recording that transaction at the same time. It's secure in a sense that it's using the cryptography technology to anonymize those transactions. It's unanimous in the sense that the network participants agree to the validity of each of the records, and it's immutable in a sense where we can't change what is recorded before. So some of them are calling it the Web 3.0, the world's computer. So all of that, embed everything that is behind blockchain. And what is really interesting, is especially, with blockchains such as Ethereum, is that the fact that with this smart contract technology, we can basically open new business models and ideas, and it's a whole ecosystem that is developing. Here we are explaining what is tokenization. So tokenization is taking an asset and converting the rights of that asset on a blockchain. So it's basically combining the smart contract and the asset into a single instrument, which inside the token. So everything can be tokenized, from assets owned by individuals, equity, bonds, shares of investment funds, services and goods of businesses. Some refer, to this tokenization process of being the next innovation of the financial markets. In a similar way, it was the case for ETFs or derivatives in the previous decades. So the main benefits basically are that it can bring further liquidity being able to fractionalize those assets. So we are able, to create really micro share. And this is great, for example, for business case around financial inclusion, to be able to fractionalize those assets and being able to transfer them really quickly at a really fast speed. The automation that is embedded inside the network bring as well the ability to create more efficient and transparent process. So it enables as well the ability to create those services at a fraction of the cost that they were before. And finally, all of that, facilitates overall the trading because we can code compliance rules or other legal aspects inside the token. So it's really attractive from that perspective to asset managers. So, so if we are looking back at asset manager, how we are seeing things at BNP Paribas Asset Management are twofold. First, tokenization can impact basically the way we integrate those digital assets in our portfolios. And secondly, how we distribute mutual fund shares. So for how we integrate digital assets in portfolios, of course, it can, we can look at the potential 10,000 digital assets that have been created over the last 4 to 5 years. But, right at the moment, we're really focusing on the regulatory side of the tokenization, side of the blockchain, I would say. So which is more regulated and as a framework. And as a result, we are looking deeply into the tokenization of alternative assets. If we look at tokenization of mutual fund shares, which is our second pillar, basically here it can enable the asset manager to be closer from the end client, moving from those B2B2C type of model and looking at direct to consumer distribution type of model, offering shares of mutual funds at the fraction of the cost we are able to distribute that today. So it offers a lot of attractivity as well.
Thank you, Emmanuel. And now I'd like to turn to Stefan and ask you which application or feature described by Emmanuel you're looking at specifically at AXA Investment Managers.
Okay, thank you, Arthur, and good morning to all. Coming back to the topic and to the title of the panel session, opening up alternative assets to investors, and following what Emmanuel said, I think there are potentially two types of alternative assets which are under coverage. You have pure, I would say, new types of assets like crypto assets on the one hand, and on the other hand, the tokenization of, I would say, more traditional assets, what we call in Europe, in the EU, financial instruments. So from an asset perspective, the interest is that we are covering potentially these two types of alternative assets. And then the critical point is obviously the technical or technological innovation implied in DLT or blockchain. Number one, purely in terms of techniques, as Emmanuel said, it will facilitate, it will do faster processes in trading and post-trading of assets, on these two types of assets. Also cheaper, because potentially through a decentralization or decentralized system, you potentially may create more competition in the chain as compared to a centralized system where you have key players in the center, I would say. So the competition aspect is very important for us because at the end of the day, it's beneficial to our end clients, because if it's cheaper, it will reduce the cost of trading and post-trading. And number three, it may be more discussed, I would say. It might bring on some part safer aspects, because we less depend on systemic key players, potentially, even though, on the other hand, in terms of safety, we will have to be careful collectively regarding anti-money laundering and the knowledge of clients. This is on the technological benefits. Regarding, I would say, the use by asset managers like us, obviously, these advantages that I mentioned will benefit both on the pure asset side, the securities we trade or the instruments we trade, not only securities, but also blockchain or DLT might also in the future facilitate the distribution of fund units, which is obviously key because once again, today it's rather centralized in terms of distribution networks. So it would be probably also very beneficial from that perspective. These are two key advantages on the asset side, but also on the fund unit distribution side.
Obviously, the buy side cannot achieve this on its own, and an entire ecosystem is needed. And Jutta, I'd like to turn to you and ask you what are our key stakeholders needs to embark this journey to make this happen and scalable. And what are your views on this?
Sure. Hi, everyone from my side as well, and very excited to be part of this discussion today. It's true that the buy side cannot do this on its own, and it would not be any fun for the buy side if it were alone in this space. So one of the fundamental elements that we sometimes overlook when it comes to blockchain-based finance is that blockchain and distributed ledger technologies are all about networks. So for the value of the network to increase, we need more participants to join. It's what we all refer to as network effects. So in order for us to actually produce value creation, we need to have a whole ecosystem that can be in place so as to be able to materialize such kind of network effects. But besides this element of value creation, which is more broad, when it comes to the operational level for the financial markets, we definitely need to have a number of stakeholders that are actively participating in tokenized markets, whether this is the issuers, the platforms helping those issuers of tokenized assets, possibly underwriters for those assets. We need broker-dealers and exchanges where such products can be traded. And we have already seen some very noteworthy initiatives, for example, the SDX platform for digital assets in Switzerland by the Swiss SIX. We need custodians, we need some sort of validators of the asset if we are tokenizing real world assets, like for example, real estate. We need wallet providers if we're talking about native tokens for securities. And perhaps at the post-trade is where we will see less players being involved than in our traditional setting, because we will expect to have less clearing houses and less of the usual counterparties if we are bringing in atomic settlement in tokenization. And of course, we need the regulators and the supervisors, very importantly, to provide the framework and all the conditions for tokenization and tokenized assets to be issued and transacted in an orderly manner. And just one final comment, which brings back this sort of interconnectedness of today's financial markets. And Stefan and Emmanuel have touched on that as well. The digital assets are increasingly becoming of interest to all traditional financial players, not just asset managers. So it's very important to continue to have an open dialogue between all the different stakeholders and with the regulators and supervisors, of course.
Thank you, Jutta. We start to touch upon which asset classes should benefit from it. Do we want to say a few words about why is it alternative asset classes are first in line? And can we maybe explore if it's if you believe it would be used for more traditional asset classes such as corporate bonds or equities? What are your views on this? Who wants to have a go at this? Maybe Emmanuel, you start.
Yes. So we are looking at both, traditional, bonds and, alternative assets. But, at the first step, we thought that alternative asset, there was a, I would say, better investment case in a sense that, especially on the private debt or infrastructure market, by tokenizing the underlying, debt that is associated to a project, for example, in the infrastructure market, we are able to standardize the credit analysis that goes the asset, basically. So the token embeds not only the asset, but as well a lot of set of data that has been standardized. And this enables us, to cut some cost. And, as well as we are bringing as well more efficient value chain, we want to lower the overall transaction cost. So according to the International Institute for Sustainable Development, the benefit of blockchain technology can reduce by quite a large number. I think it's like from today, it's from 15 to 22% the cost associated to analyzing and just setting up the project to 5% with blockchain. So I think that's an interesting number to put into perspective. And there is such a need for, for capital in the infrastructure world that tokenization can help finance smaller projects. So for us as an asset manager, it can provide diversification into the portfolios and as well potentially bring more liquidity. But I'm saying potentially as well, because as Jota said, you need an overall market infrastructure for this liquidity to happen. But as we are talking already about an illiquid asset, it's an optionality. That's why we think it's better, on the contrary, to take a standard bond, which is liquid, and bring that in a blockchain where there is not so many, participants at the moment. So maybe in the future, as we will be so many on the network, as Jota said, there would be some, trading activity and liquidity can improve. But as for now, we think that, alternative assets, it's a potential that it can offer that is really attractive to us. And the fact that we can finance smaller assets and bring diversification.
Jota, do you want to comment on the maybe the sovereign issuance perspective? Do you see any country looking at this and start to launch some pilot issuance using tokenization? Is that something you're observing?
So perhaps let me comment on the divide between equities and debt to begin with, because what we notice is that, first of all, we have had pilots for all kinds of financial securities. We have had bonds, we have had covered bonds, equities, anything, and the potential benefits are equally applying to all, but at different levels, as Emmanuel has mentioned. Now, what is interesting is that if we directly issue on the blockchain bonds, it's a bit more straightforward than equities, given that the bonds are bearer assets and we do not record ownership information on them, so the possession of the bond accords ownership. On the contrary, if we directly issue equities, it's a bit more cumbersome, given that equities are in the majority of jurisdictions registered securities. So we need to have a tokenization that will involve the digital representation of a right to a share certificate, but in most cases, we do need to issue as well on the side the traditional way of issuing the equity. Now, we do see a lot of progress being made in terms of regulatory frameworks and rules to kind of address those less straightforward issuances to cater for tokenization to be made in an easier way. And for example, I will just mention the recent initiative in Germany with the proposal for an Electronic Securities Act, which sort of creates an electronic alternative to paper-based securities. So you don't need the corresponding physical certificate. And this will make tokenization a bit more lean as a process in terms of the legal framework. Of course, all that depends on each jurisdiction. Now, I would tend to agree with what Emmanuel said before in terms of first line of priority being those alternative assets that are less liquid, that have a lot of different layers of intermediation, very heavy back office processes. And so in our analysis at the OECD, we thought that the most disruption potential will be found at the niche markets, for example, for SME bonds, very small ones, for private placements of non-listed securities that, as Emmanuel said, are nearly illiquid, and there is ample room for tokenization to enhance the liquidity, and also to produce more efficiency gains, because it's a bit more obvious as a business case to tokenize the private placement of a non-liquid or of a non-listed security than a Nasdaq share at the moment.
I mean, listening to you, it looks like it's, the EU has been working on how to relaunch the Capital Markets Union. It looks like this technology could be not a silver bullet, but certainly a great attribute to have. Stefan, you mentioned fund distribution. And if I may ask, is that something that you're already using to distribute your fund tokenization, or is it something that is still at a pilot phase? Where does ICMA stand on this at the moment?
Basically, I mean, just from a pure French perspective, there are already several initiatives which took place regarding the distribution of fund units through blockchains, I would say. So we're still in the testing approach, I would say, at this stage, because as I said earlier, we have to make sure that the whole system is safe enough, not only for us, but also ultimately for our investors. So at this stage, we're involved in various, as you said, sort of pilot approaches. We have not yet, I would say, already crossed over the Rubicon in terms of full, I would say, leverage of DLT and fund units. But we are very active on several projects at this stage. Just to come back on the asset side, about what Iota was saying, I think it's very critical that on the asset side, we need a sort of step-by-step approach or phase-in approach. And when we consider traditional asset classes, I would say, or rather traditional asset classes like bonds or commercial paper, for instance, we have already seen various initiatives taking place, like now CP, for instance, which is a very good initiative, by the way. We have to be careful on one specific point, but maybe we will come back to that later in the regulatory part. It's interoperability. Because what we have to be very careful about DLT, in DLT, you have the D of decentralized. And what is really critical is that when you enter that decentralized system, you have to make sure that still you can, I would say, continue trading in the whole system in an interoperable way. This is critical for the overall safety of the system, by the way, and of its investors and end investors. So I will really insist on that on the asset side. Interoperability is key among players in one DLT system, also among countries, and maybe later on we will mention this topic again from a regulatory perspective, but also from a technological perspective to ensure that interoperability across players in DLTs, but also across countries.
Very, very good point, Stefan, and perfect segue for my next section. Yeah, indeed, Emmanuel, Iota, maybe you want to pick up on this. Is there a risk of fragmentation given the multiple technological solution? Which, I mean, the underpinning question is, which blockchain solution will be used for the tokenization process? So is there a risk of fragmentation? And I guess fragmentation can happen both on the on-chain world, but also fragmentation as a whole, on-chain versus off-chain, how to make sure that by building the on-chain world, you don't necessarily take liquidity out of the off-chain world. But maybe just let's focus on the on-chain, and is there risk of fragmentation, and what kind of technological solution you think will be used by the market?
Yeah, when you look at all the pilots that are happening, basically we can see that they are done often on different type of blockchain, and at the end the market fragmentation or the technology fragmentation question is fair. But when you look at the pure cryptocurrency world, they have been managing to create bridge from one blockchain to another. So there is more and more, solution for interoperability of blockchain that are being developed. And I think by the time, that we will have the global regulatory setup for security tokens to evolve and be liquid and so on, I hope that we'll be able to have good bridge between each blockchain solution so that we can have a uniformized, I would say, market. So I don't have any crystal ball, but that's, I would say, my hope. And from what we see from cryptocurrencies market, I would say that, it's fair to see that technology is evolving super fast. Jota, do you want to say something as well?
Yes, I perfectly agree with all what you said, Emmanuel. And also Stefan's point about interoperability is one of the most critical ones for the success of the tokenization markets and of all blockchain-based financial applications. One of the things that maybe we can add is that the market is far from being mature today. And with all the fintech applications that we have had, the different waves of financial technology in the markets, we've seen that they go through different phases, and it is only when the market starts maturing where we see some sort of convergence and the strongest players survive and kind of dominate. But in the case of DLT technologies, which, by the way, blockchain is a DLT, but not all DLTs are blockchains. So perhaps we're a bit more used to using the blockchain term because of the Bitcoin, but it's a broader market than that. In the DLT space, perhaps what will also make the distinction of the winners in the end will be the needs of the applications that are built on the different chains. And I will give one specific example for that. In the DeFi space, the decentralized finance market, more than 2/3 of the applications are built on the Ethereum blockchain. And why is that? That's because in the DeFi space, what we have is a model of person to smart contract or smart contract to smart contract. So the smart contracts are critical in the DeFi space, and the Ethereum blockchain is actually the one with the most functionalities or the most easily used for smart contracts. So this is what drove the choice of the Ethereum blockchain for the DeFi space. So perhaps this is also going to be the way that the market will select the dominant players in the future years. But again, this is still to be seen.
Jota, if I may ask you another question, and I think it appeared in the chat. People were asking about CBDCs and the link with tokenization. Can you maybe explain why CBDCs could be important to ease the tokenization process and what kind of role they could play?
Sure, so that's a very good question, and it's one that brings the focus to the post-trade of the securities life cycle. So if we take a step back and think about where we see the most potential for efficiencies through the use of tokenization, this is at the post-trade based on our analysis. Because tokenization will allow for settlement that is real-time, what we call atomic settlement or atomic delivery versus payment, we will move from T+3 or T+2 to T+0. So there will be a real-time exchange of the securities transacted and of the corresponding payments. Now, in order for us to be able to achieve this kind of atomic settlement, we need to have a tokenized form of fiat on the blockchain for the payment leg of the settlement. Otherwise, we will bring back to the chain an off-chain process with long processing times of fiat, the costs of involving off-chain intermediaries for that payment leg. So what we already saw for more than 2 years now in pilots has been some sort of tokenized form of central bank money for example, in the project Ubin and Jasper, even in project Helvetia of the BIS Hub, where we try to bring in a tokenized form of central bank money on the chain to be able to secure the payment leg of the settlement and have this sort of simultaneous settlement. Now, the private market, as CBDCs are non-existent today, are using stable coins for that matter. So stable coins are basically private money brought on the chain. Now, whether the tokenization market will be allowed to link to the central bank payment infrastructure, this is going to depend on the policy decision of issuing wholesale CBDCs or not. Why we think this is important is that first, we have seen a very encouraging wave of pilots by central banks trying to experiment with CBDCs. And there may be some benefits to the use of CBDCs versus stablecoins for the settlement of tokenized assets. Because for the users, it reduces any counterparty risk and liquidity risk, of course, if we have the central bank fiat. But this is all remains to be seen, but it's very, as I said, it's very encouraging to see all this activity. And in my personal view, issuance of CBDCs will be a strong catalyst for the development of tokenized markets.
Thanks, Jutta, and I think it's a nice segue with the topic of regulation, which is our last topic we wanted to cover for this panel. And given that you work for ECD and you look at things at global level, Jutta, I'd like to go back to you again and ask you, what are regulators doing in that space? How do they perceive tokenization, and what have they done so far? And do they have a role to play to enhance this or enable this process more broadly?
As with any financial sector activity, there is certainly a role for policymakers to provide the conditions that will allow for this market to be developed in a safe manner, protecting financial stability, protecting financial consumers, making sure that the markets work in an orderly and transparent fashion. So there is definitely a role in this market for the regulators and the supervisors and any other policymakers. Now, what we've seen at the OECD is that there has been a lot of progress made in terms of policy action for tokenized markets, and we documented this in a recent report. Of course, we have a lot of jurisdictions in advanced economies with a technology-neutral approach to regulation. For example, in the US, we have all we need in terms of existing rules. So in those kind of markets, what we hear from market participants is the need for more clarity and more guidance on the frameworks that are applicable to tokenized markets. And we have seen a lot of this kind of communication also advancing from the side of policymakers to help the market better understand what kind of rules apply. Then we saw in other jurisdictions, other approaches like trying to adjust their existing frameworks to cater for specific innovation parts of the technology. We have had also countries that have introduced very new and tailor-made regulation and frameworks for blockchain-based securities. For example, Japan has introduced a framework for security token offerings, and they cover everything related to tokenized securities in that. We've had also countries that have introduced new roles that we didn't have before. For example, in Liechtenstein, we have this new role of physical validator. So when we are tokenizing real assets, there is someone who actually makes the on-chain, off-chain validation of the asset characteristics, that the asset is not tokenized twice, and all that. Now, at the global level, of course, this is one of the most important areas because DLTs are by definition global. So the cross-border part of the tokenized markets still requires, in my view, some level of international dialogue, both to limit the regulatory arbitrage risks, but also to foster the development of those markets. And this is a goal that we are pursuing at the OECD, both through analysis, but also through our convening power and supporting the international policy dialogue around tokenized markets.
Thank you, Jutta. Stefan, can we maybe say a few words about what's going on at European level, narrow down a bit the spectrum of the conversation? Are we going in the right direction? And yeah, what are your views on what the EU has done so far in this space?
What Jutta was saying was very true. I mean, as far as possible, getting a consistent international regulatory approach would be optimal in terms of facilitating, as I said earlier, a sort of a interoperability and approach from one country to another. But we have to start with something first. And I think, and ICMA thinks in general, that this EU or European Commission's initiative launched last autumn, the so-called digital finance strategy, was really an excellent initiative, very proactive, very, I would say, future-oriented, and it's very critical for the EU to take some lead, not excluding the other regions, but to take one lead in that critical dimension. And typically, having a single market or consistent EU approach, both in the DLT and also the crypto asset regulation, is critical for cross-border players, obviously, like ICMA, but also more largely. So it will give a sort of a better safety, not only in the processes which will take place, but also possibly, by the way, in the investment in crypto assets, because as long as regulation is not put in place at a sufficient level, many players, including us, have not, once again, trespassed the Rubicon yet for investing in crypto assets at this very moment. Maybe it will arrive soon, but we needed some regulatory framework at a minimum. So this initiative is excellent. Just two elements I wanted to mention on DLT pilot regime as proposed by the European Commission. We think that number one limit is that the thresholds for eligible securities of eligible financial instruments is probably too low. The scope is very narrow in terms of eligible assets by size, I would say. We may understand it because the EU wants to have a safe approach and careful approach and does not want to open too fast the DLT to a wider range and volume of assets, but still we think that the current thresholds are too low. And number two, it's very critical, coming back to my topic of use of fund units and distribution of fund units. We think that among the eligible assets, definitely fund units should be eligible, at least UCITS, which are the safest funds regulated in Europe, should be eligible for DLT pilot regime. This is critical, at least for fund managers. Another aspect I wanted to mention, we have to keep the idea of facilitating the entry of new entrants in the DLT regime. On that front, it's not easy, but we have to find a balance, to strike a balance between ensuring a safe enough framework, but not excluding new entrants to enter the DLT processes. So the discussion is not over yet, and we still have to be careful on that front, not to exclude new entrants, to keep competition with between new entrants and existing players in the trading and post-trading world. Last but not least, we need some minimum level of safety, as I said, at least on two aspects. The first one is still on AML and KYC. Decentralization, as I said earlier, might create some questions or concerns on that. And so we have to make sure that AML and KYC are treated fairly and in a sound manner, because we don't want, I would say, any scandals which might hurt this innovative regulatory approach. So we need some minimum level of safety on AML and KYC. And last but not least, I'm thinking about market abuse. Currently, at the level of market abuse and investor protection, many investors, both retail and non-retail, have jumped into the crypto asset world as investments. We have to be careful on that. It's a good spontaneous initiative by investors, but for the time being, at least, there is no regulatory framework. MiCA is going to tackle that topic, but we have to keep in mind that currently many retail investors are jumping in crypto assets where they are not protected at all. While when they invest in traditional financial instruments, it's a MiFID, then you have a significant investor protection aspect. So for the Commission, it might be maybe a transition for the rest of the discussion today. For the European Commission, it's critical to ensure that at least retail investors are protected sufficiently if investing in crypto assets, because they should be as protected vis-à-vis crypto assets as they are for traditional financial instruments, to avoid once again any scandal which might hurt the development of innovative new fields.
Thank you, Stefan, and maybe it's a point we can address to Matthias after his presentation.
Can I jump in on this, Arthur? Just
please go ahead.
As we see increasingly the divide between the crypto world and the traditional financial services becoming more porous, I think that it's also worthwhile to highlight that when we're talking about tokenized securities, we should not mix this up with the Bitcoins or the MakerDAO coins or Tether. We're talking about regulated financial instruments that are just in a different, issued through a different technological means and transacted in different technological means. I'm just mentioning this because the reputation of this market is tarnished by the bad actors and perhaps a minority, but we should concentrate on stuff that are beneficial for the markets and which are coming under the umbrella of our financial regulations and rules, and try to have as much of a distinction as possible when we discuss the potential of this market.
Good clarification. Thanks, Jutta. So I'll read one of the questions. And feel free to jump into response. I won't nominate you. If I buy a tokenized assets, for example, real estate, how do you define who owns what piece of, say, the house? Do token holders have any real ownership rights? And how would you be able to enforce these rights?
I can start and then anybody can complete, right, Jutta? So basically, yeah, it's really difficult because when you tokenize a real asset instrument, there is a lot of legal structure in between the final assets and the token. And basically, it's mostly, I mean, as stated in the question, there is the answer inside, the economic benefit. But at the end, we are able to track back, this specific asset that is part of the usually it's SPV that is created, that the token will hold and that we will basically fractionalize. So I don't know, Jutta, if you want to add a bit of that on that.
I think that at this stage we are at pilot phase and we have seen several pilots. I will just mention one in France. The EquiSafe platform has tokenized a big mansion. So you can look at the details of that, but it will depend 100% on the jurisdiction at that stage. Because we are not talking only about the rules of around tokenization, but we are also talking about corporate law, whether you can actually assign ownership to the tokens in that particular jurisdiction, and other things that are at a national level defined.
The second question, I think that links up a bit to this one, so I'll have a go at it. When it comes to tokenized assets on a decentralized network, if a court deems a sale of an asset invalid, how would the one be able to revert the transfer of, say, the token? What if the buyers of the said token refuses to transfer this manually? Who's the owner of the underlying asset at the moment in time? It's very specific questions, but it's about the credibility or like the safety of this underpinning technology. How do we make sure that rights are protected?
I can have a go at this, just mentioning that when we're talking about tokenization, we're not talking just about me, my computer, and then a real asset somewhere in the nature. There are all the different participants and stakeholders that we talked about earlier in our discussion, that will make sure that that this is actually equivalent to a contract that you would sign at the notary. You know, everything is coded and programmed, but those clauses exist. But again, I would like to highlight that there is, to have a specific answer for those specific questions, we need to know the jurisdiction, and we need to have corporate lawyers and civil law and lawyers and all that.
If I may, I mean, the funny thing in tokenization projects, it's at the end, it's not technology project. It's mostly, you know, legal and compliance projects. You know, you tend to have, you know, the engineers creating, you know, the platforms, but on the back, you know, there is a lot of lawyer and compliance officer involved, even, you know, spending more time, I would say, that on the technology front. So, you know, that's why I think, I mean, Yoda there is a lot of if in each of those questions.
The next question is, do you see similar opportunities in do you see like the use of tokenization for the corporate bond segments? We've touched upon this a bit. Do we want to say a few more words? Do you expect DLT to enhance liquidity, or would the concept of real-time trading settlement be difficult to reconcile with the dynamics of this market segment?
Maybe I may jump in on that. Definitely, we at ICM believe in that. Once again, it might really develop on that segment, as already said earlier, as I said already earlier. But once again, and mixing also with a comment by Emmanuel a few minutes ago, it will depend on two dimensions, which are the technological dimension and the legal or regulatory dimension, to make sure that the overall framework, both technological framework as well as regulatory framework, combined and mixed, and the third dimension being geographical, cross-border. In fact, there are three dimensions: regulation as such, technology, and cross-border, which will require to have interoperability, as I said, not only beyond players, but also across countries. Once these three dimensions, interoperability, regulation, and technology, will fit together, then definitely we believe that it might become a significant channel for the future exchange of bonds, as I think it was a question.
Okay. We're running out of time, unfortunately, so we can't take all the questions. With that, I mean, I'd like to thank you, Emmanuel, Jutta, and Stefan. Thanks again for attending this panel. I hope you enjoy the rest of the conversations today. And with that, I'll hand the floor back to Bob. Thank you all for listening.
Arthur, thank you very much indeed. As we know from the EU budget that was agreed at the end of last year, and also from the Next Generation EU Fund, which is now launching its new bonds actually this week with an 800 billion program, digitalization is one of the core factors in the budget and the strategy of the EU. So, you know, I'm very pleased that Matthias Levin can join us. You know, he is deputy head of digital finance unit at the Commission, and he's going to basically give us a short presentation on the EU strategy plans and also any legislative or regulatory aspects. So, Matthias, over to you, please. I think you have a number of slides to show us.
Yes, indeed. And I think they're being launched as we speak. Thanks, Robert, for that kind introduction. And let me also take the occasion to thank the previous panel and its participants for an excellent debate, which I think already provided a kind of a nice bridge to some of the themes that I will bring up in my intervention here today. I'll try to be relatively brief. We focus on a lot of, we capture a lot of ground, but I'll try to focus it on the kind of themes that are of particular interest to you who are attending this talk today. So I will try to give you a kind of an overview of how we see the process of digital transformation affecting the financial services sector as a whole. The objectives that we have identified from the Commission side that should guide our actions in the years to come, and the strategic priorities that we have identified to that effect to reach and achieve those objectives. And within that, I'll try to focus, as I said, on some of the things that I think are more relevant for you today. Some of the themes already related to crypto, etc., that was brought up expertly by the previous panel. So I think here it's just basically put it in a very big context. Robert, you also alluded to digitalization being a top priority of the Commission and the EU currently, and that's indeed the case. I think the President of the Commission, who you see here, Ursula von der Leyen, really put it quite succinctly that this is Europe's digital decade for the society and economy as a whole. This is such a broad-reaching transformation that we need to get on top of and master. We need to not only be kind of passive takers of kind of technology solutions proposed elsewhere, but we also need to be able to create a climate so that actually we can have homegrown solutions as well. So lead the way on digital as well. And that relates to a broad amount of things, be it the data economy, be it making sure that our rules are fit for purpose, putting in place the basic digital infrastructure such as digital IDs, for example. And I think this is very clear where it comes from. As I mentioned, we have a process of transformation that has been ongoing for quite some time. Technology, as you who are attending the webinar today know far better than we do, is not something new in finance, but it is a process that's accelerating with time and becoming deeper and deeper. And we have seen how it changes the way we organize societies, how we organize our own private lives. And for firms and others, as also been alluded to in the previous panel, this creates new kind of ways of doing business, new business models, new opportunities, etc., that have to be reaped and captured. Of course, with the pandemic, this has largely accelerated, and we believe that this acceleration is not temporary in nature. Even once we master the pandemic, I think that this will leave a lasting imprint because we've discovered new things, ways of doing things. We've discovered that societies continue to function largely in lockdown and that provides certain kind of long-lasting values. So it leaves us as policymakers, because that's where we come from as the Commission, with quite fundamental questions, and we really need to get on top of this. And for us, DG FISMA, as my department is called, Financial Services Department of the European Commission, we are in a sense in charge of managing the regulatory framework of the single market for financial services. How do we handle that? We can see that digital technologies bring a lot of benefits and changes the way that consumers and firms meet in the single market, and how do we attune our regulation to that effect? Also, we see that there are new actors coming in, new ways of doing business, new applications, etc. That brings both benefits and risks. And what does that mean for our regulatory framework? So that's the very kind of broad brush context to why we adopted the package last year, which I think the previous panel already alluded to. So that package was an attempt to kind of set out where it is we want to go, which is essentially to create opportunities for consumers, but also protect them when they use new digital finance applications. And we really want to build an open digital single market, but also innovative and competitive at the same time. And to that end, we identified 4 strategic priorities where we will need to work further. First relates to how we actually fairly traditional from a single market perspective. How do we reduce fragmentation? How do we tackle the kind of digital fragmentation we see today? Fragmentation is not something new. It's something that's been us since we started the single market project a number of decades ago, but it changes shape and focus. And hence, there's a few issues there that we need to look at from a digital finance perspective. Secondly, how do we make sure that actually our EU regulatory framework facilitates digital innovation? The webinar today has already started to look into that a little bit because a lot of regulatory questions came up in the previous panel, and that's perhaps the bulk of the package that I'll focus upon today. So the second priority of the regulatory framework and how we make sure that it's fit for purpose in a rapidly innovating digital world. The third priority is all about data sharing and data aggregation. How do we create a kind of European financial data space? I'll touch upon that very briefly. And fourthly and finally, whereas the kind of 3 first priorities are very much kind of focused on how do we actually make the most of opportunities that digital technologies and digital finance may bring, it also creates certain challenges and risks, and we need to tackle those. I'll briefly conclude on those as well. So first one, just the fragmentation. I think here a key financial market infrastructure that is very important for a lot of other things digital finance applications take off is digital identities. We see projects being developed at national level. They differ a little bit. They work pretty well in national context, but they do not really work in a single market. And that is mainly due to different national frameworks, different cultures, different supervisory cultures, etc. And that we need to address. We've already started to do so. We put forward a few weeks ago a new framework for European digital identities, which will include new services such as digital ID wallets. And we also, and I think this was alluded to in a previous panel, are currently reviewing EU anti-money laundering rules, which will also look at harmonizing customer due diligence requirements. And that is also forthcoming very shortly. The combined thrust of these two proposals would be that it would help consumers to access cross-border services, to actually be able to use their digital identity solutions for verifying who they are, to also actually access opportunities, financial services applications elsewhere beyond their home country. It's a very kind of classical European single market kind of thing for that too. But of course, also for firms providing financial services, this is a benefit because they would be able to more easily remotely onboard clients coming from another country with an increased recognition of the various ways of verifying your identity in a digital way. So that's just to give you a flavor of a kind of first the actions that we are taking to achieve a kind of first strategic priority. Now let me turn to the second one, which is really about how we can look at our regulatory framework to ensure that it actually facilitates innovation also in the digital space. And here we have started, that is essentially us reviewing our framework in light of specific technologies. This is something that we started a few years ago, mainly on crypto assets. And that then led to, together with us, adopting a strategy last year, also tabling these two legislative proposals that were mentioned by previous panel participants. I'll come to these in a bit. But of course, this is also an ongoing review that we will have to look at other applications to see whether the way that we regulate things actually can handle other technologies as well. And we more recently, actually, it's not June, but April this year, put forward a proposal for regulation on artificial intelligence, which I believe is of interest to this webinar as well. So I'll say a few words about these two areas. But just before I move on to the next slide, just say that this is a kind of a general endeavor of us as guardians of a kind of a single market financial services body of rules to ensure that we look at these rules continuously, regularly, with a view to review, but actually they are technology neutral, that they do not lock in a particular kind of stage of technological development, but that they actually evolve in light of developments that take place. So let me now turn briefly to crypto, perhaps also trying then to address or bring up some of the themes that the previous panel brought up. So I think in the previous panel, one thing that came up is that market participants quite often when it comes to crypto assets need a bit of guidance, a bit of clarity about the rules that apply. That is certainly something that came out of our consultations leading up to the strategy in these legislative proposals. But in the sense that it's quite clear sometimes that there are certain crypto assets that qualify as financial instruments and hence are securities and fall within existing financial services legislation at European level. However, there are a vast range of assets that do not, and that currently are actually unregulated at European level, maybe regulated at national level. It's not sure, maybe completely unregulated. And that together brings a lot of legal uncertainty. And that legal uncertainty is a key impediment for actually these assets take off. So what we try to do then is to put two proposals on the table. One proposal, and that's the one on this slide, was to kind of regulate the space of assets, crypto assets that fall outside for the time being, that for various reasons do not meet the definition of financial instrument and hence do not qualify for being regulated under existing EU financial services legislation. So what we wanted to do here is to then look at these assets and to regulate them, but not just copy paste what we have in the kind of financial services space, but to apply proportionate requirements to ensure that we have an enabling framework that enables these assets to take off, that provides providers and consumers with the clarity they need, the protections they need, and the safeguards that they need. So that's what we've tried to do. So MiCA, this Markets in Crypto Assets, regulates the issuers of crypto assets, and it also regulates the service providers of crypto assets, be it portfolio managers, wallet providers, custodians, brokers, trading venues, etc. Going back to the issuers, we here capture two different kinds of assets. First, the kind of what we label ordinary crypto assets, which are everything that essentially kind of does not meet the definition of financial instrument, and that does not have any kind of ambition to try to stabilize its value. So it's a very kind of broad category that is very heterogeneous, and here we apply a very, very kind of proportionate requirements and a proportionate degree of supervision. But then we also, of course, have a rapidly advancing kind of stablecoin universe, which I think also previous speakers alluded to. And that's where we need to be a bit more cautious and careful, given that they have a significant potential to actually become quite widely used, which may raise a certain amount of questions, and which then requires to take a closer look that the stabilization features actually do work and provide the safety that consumers can expect when they actually buy these tokens. And here we then provide specific requirements on these stable coins, which we have kind of divided into two buckets: asset reference tokens, which may perhaps reference a fairly broad set of instruments, including several currencies, and the e-money tokens, which, due to the fact that they only have reference one single currency, become quite similar to e-money and hence should be regulated in a way that is similar to that, notably in regards of consumer protection. So that's what we try to do, a common EU framework, tighter rules, and EU supervision, in particular for stable coins. And I think also just to take the occasion to then also highlight the question, I think it was Stefan in the previous panel that highlighted the importance of also addressing anti-money laundering rules, which we fully agree with. What MiCA does is it lays the universe of regulating the crypto asset ecosystem, the various service providers, etc. And then in a second stage, this ecosystem will be incorporated into the forthcoming revision of the anti-money laundering rules that the Commission is currently finalizing. Previous speakers have spoken a lot about the vast range of experimentation that is taking place in the security token space. So whereas MiCA was focusing on the kind of the unregulated space that fall outside the current kind of securities market space, this proposal that we table is expressly focused on the kind of those crypto assets that actually qualify as financial instruments and that fall within the kind of securities market space. The feedback that we had got from stakeholders in the build-up to delivering these proposals is that actually there are some problems that hamper the kind of experimentation in the market that stem from the way that we regulate at EU level. And that is essentially that where we've concluded that the way that we regulate the value chain at European level may not be entirely technology neutral, in the sense that they lock in a particular way of organizing the trading and the post-trading chain. And to address that, we need to able to provide a little bit of freedom under controlled circumstances, so that the market can experiment with DLT security token issuance without being kind of hampered by these specific rules. But we need to learn more. We need to know more. The market, this experimentation, impressive as it is nevertheless at its infancy. So before kind of looking and reviewing the kind of more fundamental legislations governing the securities trading and the post-trading space, the aim of the pilot is to gather more experience. So we put in place a temporary regime that under certain conditions will allow operators of DLT market infrastructures, a new category, essentially investment firms or market operators regulated under MiFID could apply to run a DLT MTF, or CSDs could apply to run a DLT security settlement system. And they would then be able to apply for that permission and then to seek targeted and specific exemptions from the requirements set out in the foundational EU legislations, namely MiFID, MiFIR, and CSDR, that governs the trading and the post-trading way of doing business, in order to be able to kind of issue that, in order to be able to kind of issue such DLT security tokens and to be able to settle and trade them. That is subject to safeguards. Previous speakers have also alluded to whether or not these safeguards are too strict. That debate is indeed ongoing. There are various views around the table. Some believe that indeed, similar to the views that were expressed previously, that we need to allow more activity under this pilot, whereas others are a bit more cautious, stressing in particular the kind of safety, the fact that actually here we're speaking about fundamental kind of safety market infrastructures, which are very important for the financial stability. So there's a balance to be had. But just to echo the kind of discussion we had in the previous panel, there is very kind of strong emphasis in this debate, not only on the kind of how much activity, but also how we get this right. How do we actually bring in an efficient settlement of the payment leg in the absence, for the time being, of the kind of wholesale CBDCs or kind of more widely used e-money tokens, or kind of commercial bank money in digital token form. So that's a lot of the debate on that one. Now, I've so far focused, and we are still under the kind of general heading of how we look at our EU rules to ensure that they are fit for purpose. I've focused so much on the crypto space, where I've been more actively involved. The Commission as such, other colleagues and me, but I've also looked at other technologies. Artificial intelligence is a case in point. And as I mentioned at the outset, the Commission came out with a proposal for regulation earlier this spring in April. And what this regulation does is that it tries to lay the groundwork rules to ensure that there is clarity for market participants and users about how AI systems would be put on the market, in the single market, in order to kind of facilitate trust in these systems. So it does so in a kind of a very kind of a risk-based manner. So it kind of looks at tries to establish kind of a category of AI systems depending on the risk they pose to customers in terms of safety and fundamental rights protection, for example. So here it's a certain number of kind of AI, a very limited set of practices will be prohibited. The vast majority of AI systems have been concluded do not actually constitute any risk at all, and hence will not be affected by the regulation. But there are some things that fall in between, which can be potentially high-risk AI systems because they touch upon certain issues that are important for the wider public, be it because it limits in a bit either the access to private or public essential services. So these would be considered in that case high risk, and they would then be subject to additional obligations, that are some of which I've listed here, namely related to increased transparency to consumers, the need to factor in human oversight, specific obligations related to data accuracy, robustness, and the like. And in finance, the proposal sets out a number of kind of AI high-risk use cases, which already today have been categorized as posing high risk. And in financial services, there is one use case for the time being, which relates to the kind of a credit worthiness of persons, so credit scoring systems and the like, because this may impact people's ability to access loans, for example. Now, here as well, of course, these rules have to kind of interact well with existing legislation in financial services. So basically what will happen here is that entities that are not regulated and supervised under EU rules, for example, credit bureaus, would be subject to the full set of rules. Whereas, for example, credit institutions, which are subject, as you all know, regulated by EU law, the supervision of their compliance with the rules would actually be integrated into the existing financial supervisory system, which is set out and harmonized at EU rules. Now, conscious of time, I'll try to more rapidly kind of conclude to provide you with this kind of broader overview of the kind of policy focus in digital finance. As I mentioned, data sharing is, of course, a key theme these days as well. And the area of finance, we will try to contribute to the kind of more horizontal policies on achieving data sharing for the economy as a whole by establishing a kind of financial sector data space. Part of that will look at the kind of supervisory disclosures that many of you in this webinar who work for financial firms have to disclose under existing legislations. We are looking at how we can aggregate these and to put that in a single access point to kind of facilitate not only your compliance, but actually investors' access to that information, and technology can help in that effect. So there are efforts ongoing in that respect. Another theme is also, of course, the same thing for supervisory reporting. How can we actually make most use of technologies to make that easier to kind of report, and also for supervisors to use? So that will also be kind of a second big leg under this data sharing. But the third big leg is probably the one that tends to assume most attention, which is how can we kind of build on the open banking approach that we put in place in recent years via the Second Payment Services Directive, and to expand that to a broader range of banking and financial services sectors, in a sense to not only share data as regards kind of a payment service when it comes to banking, but actually broaden it to other financial services as well. So to move from open banking to open finance. And there we've committed to have such an open finance framework in place by 2024. And we are currently actively looking into how that can be done, and identifying key user cases, and also looking at different options to that extent, for example, which the balance between regulatory and self-regulatory options in that case. As I mentioned, what I've been speaking about most so far is about creating opportunities. The other thing is very much focused on kind of risks. We have new actors coming in. We have seen also that resilience to cyber attacks, etc., under the lockdown has become at the forefront of everybody's attention. We have tabled another legislative proposal, which I will not go into today. The DORA, the Digital Operational Resilience Act, focuses on that. But there are broader and more fundamental things which are underway that we're starting to see the signs. The entry of big techs, the fragmentation of value chains, and much more complex and kind of varied ecosystem with kind of financial services actors and technology actors interacting in various ways. And we need to look into that. So we're working with European supervisory authorities to get advice on how to do that, and we'll act upon that in due course, according to the kind of same risk, same rules, same activity regulation approach. So that was covering a lot of ground. I tried to focus on crypto and AI, but Robert, over to you.
Matthias, thank you very much indeed. That was very comprehensive, and you covered a lot of ground in a short time. Just before we pass on to the next panel, just two very quick questions. Obviously, a lot of work is being done by many participants on digitalization, and I would just highlight the report that came out last week from the Basel Committee on Banking Supervision. Obviously, the central banks are looking very closely on how to develop digital currencies. And you mentioned that you're working with regulatory authorities, whether it be the European Stability Board, the ESMA, other European authorities. But one challenge, I think, here is just coordination amongst all the different players and participants who are working on this development. And is it fair to say that you're trying to centralize this activity at Commission level? And what are the challenges in coordination here?
I think coordination is key. You're entirely right, Robert. So, of course, what we try to do with the strategy is to kind of not necessarily centralize within the European Commission. I think that we're modest enough to understand that we are not at the center of everything, but to at least bring together and to identify the key themes that we believe we should all work towards, and all the actors involved, be it the international standard setters. Of course, they have a broader remit than Europe, but especially within Europe, to kind of focus member states' attentions, to focus the European Parliament's attentions, who are legislators, but also supervisory authorities and the market participants and a broader range of stakeholders who are involved in this space, to have a kind of a common vision about where it is we want to go, how we can get there, and to ensure that we all move in the same direction. So I think that is the general ambition. And as I said, we consulted a lot in the build up to that, we tabled certain proposals to deliver what we believe the vision, and we are actively negotiating and getting feedback on these proposals. So it is indeed, and then it is always a kind of a moving process. As you mentioned, the Basel Committee is looking into that. And indeed, when it comes to the proposals on crypto assets, there has been debate among legislators what should be banks' involvement in the crypto asset space, given that certain of these assets at least pose fairly significant risks, and that are also the issues that then, from a prudential standpoint, the Basel Committee is looking at.
Matthias, many thanks indeed, and that was very helpful. I'm hoping that people will have follow-up questions for you, and at a later stage, perhaps later in the year, we'd certainly like to invite you back to an AMIC meeting. So once again, thank you very much indeed. Now, let me just pass on to Max Castelli from UBS for our second panel. And there we're going to be talking about the use of artificial intelligence. And Max, I'm just going to have one rule on this panel, which is please can we ban the use of the word black box, which I hate. But anyway, over to you.
Thank you very much, Bob. I will not use that word, which I also don't like. First of all, thanks to everybody for participating. I think you already had an idea of what all this event is about. It is about the impact of digitization on the financial service industry, and in particular on asset management. You heard in the first panel about tokenization, which I think is part of the broader question of the use of digital currency and digital solution within the asset management industry. This is definitely something which is perceived as disruptive. And of course, this includes other aspects that we haven't touched in this event, for instance, central banks and digital currency, which is also a very important development for the overall industry. And another one where we would like to shed some light in this panel is about the use of artificial intelligence. In fact, the artificial intelligence actually is already being used across the industry. And the implication of the use of artificial intelligence in the asset management industry are multiple. First of all, it is about how does this impact portfolio management and investment in general. The second is about, of course, the impact that this can have in terms of operation. And we already heard something in the first panel, for instance, back office reporting, etc. And of course, there is another impact which is on the client relationship management, for instance, in terms of how the industry serve clients. Think about Robo Advisor, for instance. Finally, but not least, is of course on the business model which we have in the asset management industry. So for that, I have. So let me present the three of them. We have Prasenjit Bhattacharya, Global Lead Innovation and Responsible Investing at NNIP. Electronic Trading and Market Structure, ICMA at BlackRock. So without further ado, I would like to immediately do that. I will read the question and pose them to the panelists as we run. From Daniel, just to lay the ground, can you please, Daniel, define for us artificial intelligence?
Of course. Thank you very much, Max, and hello everybody on the lines and on the video. So artificial intelligence, machine learning, data science, they are all kind of topics du jour at the moment, of course, and there's a lot of enthusiasm in this area. I tend to think of these different concepts as different forms of technology innovation in a way. And you can start off with maybe automation. Automation is replacing what used to be people picking up the phone or doing clicks on the computer, just turning that into automated steps and making the process more efficient. The next level are models and uses of data. That's also been around for a very long time. And then finally, kind of the next level where AI comes into it is, I'm going to break the rule, is what most people would kind of consider the so-called kind of black box modeling, even if it's not entirely a black box. But what that means is you depart from the more traditional ways of modeling. You use kind of non-structured approaches, and it's less intuitive to always understand what's going on under the hood, but that's where the magic happens. And that's what a lot of people would consider as kind of the artificial intelligence component. Now, I would kind of, just to frame this discussion, say, as a panel, I'm assuming we're going to be quite liberal in our definition of artificial intelligence, and maybe kind of for the audience to bear in mind, when we use that term, we're probably often speaking about technology and data innovation and new techniques and computational powers in general, and the opportunities that come with that, rather than an AI definition in the strictest sense. However, bearing that in mind, I think that's a good mental framework for us to think along, because it'll help us with questions in terms of what do we need in terms of new regulation? Do we even need new regulation? How do we embed this in our business processes, etc.? So it's just important to have that framework in mind of what is actually new and what isn't new. So bottom line, we're going to be quite liberal and define artificial intelligence in the broadest sense here.
Thank you very much, Daniel. Very useful to frame the discussion. And we will actually go back to some concrete example, even to make this more explicit in a moment. Before doing that, let me turn to us, how is the AI used across the asset management industry?
So thank you very much, Max. And it's a great pleasure for me to participate to this panel. So thanks for the invitation. Yes, so to start with, I would say I fully agree with Daniel's definition of AI. I think it can be used at various stages. And I would consider that there are four main value added to our asset management businesses. The first one is to provide new methods of predictions that are allowing to deal with complexity. So, for example, nonlinear dependencies or large number of features that have an impact on, for example, returns, if you're trying to forecast return. Another thing also in this complexity dimension is how to deal with missing information. I will come back to that. And I think that Prasenjit also did some very interesting work on that. And the last dimension of complexity is how to deal with models that are able to incorporate feedback from the environment. So one example of that is trading. I mean, when you are trading, your own trade is impacting the market. So we need models that are able to incorporate that feedback within the model itself. So that's the first value added, new methods of prediction allowing to deal with complexity. Another value added for me are new methods that are able to process unstructured and high dimensional data, such as, for example, natural language data arising from news articles, company reports, social media, satellite images, etc. A third value added is to bring better optimizers, for example, for non-convex optimization problems. And the last one that Daniel also briefly mentioned is the new forms of clients interaction. So I think that's a quite exciting field, even if it's not AI in a sense of sophisticated machine learning models, but it can bring very interesting questions about how a robot can interact with a client, typically in the robo advising space. But you could think also about development in the fund distribution platforms. So there are very interesting dimensions in that. I could give you a few maybe concrete examples to illustrate what I said, which are based on things we've done ourselves at Amundi. So, for example, forecasting stock return, something very basic, very useful that we're doing all the time. We know that there are many features, many characteristics that, so firm characteristics that can impact stock return. What we did is try implementing many machine learning experts on more than 100 characteristics, and then aggregate these experts with aggregation methods in an efficient way. So typically minimizing regret, for example, to lead to build a new prediction. We use natural language techniques as well, for example, to build ESG sentiment indicators and see how much is it incorporated into prices. We've been using Bayesian networks to forecast trading costs. So Bayesian networks are particularly interesting because they're able to restore missing values by inferring their most probable value given the state of the world. And something which is particularly important if you think, and maybe Daniel will touch on that later on as well, if you think about forecasting trading cost, one key information is the order flow imbalance. How much buying or selling pressure is it in the market? And that's something which is typically only partially observable. Either you only observe your trade or you observe a subset of trades. If, like Amundi, for example, or maybe BlackRock, you are operating a large number of trades of other investors. From this subset of trade, you can infer information on the global market, and these kind of Bayesian networks allow you to do that. So I could multiply examples. I'm going to stop here, but that gives you a kind of overview of how these kind of techniques can be used and what value they bring to our business in the asset management industry.
Thank you very much, Mary. I would say that this is basically a sort of additional tool made available to asset manager to really process data and provide information in the investment process. So very important. Let me turn to Jet and maybe just to talk about the different asset classes. Actually, we had this approach also in the first panel. It sounds like very much an equity story. Is it just equity, or it is a broader application of artificial intelligence in the asset management industry?
Hello, good morning, everyone. Thanks, Max, and welcome fellow panelists and people joining online. So yes, let me first acknowledge that it's good to set up the context in terms of the liberal definition. So, and the way I would define it as AI as an ability of machines or non-sentient beings to solve complex problems. And to your point, Max, if you look at from the lens of maturity, so definitely equity is a bit further ahead of the curve. And that is specifically because over last decades, within the context of empirical asset pricing, two main themes have been dominating or monopolized the research agenda. So the one was the curiosity to understand what is driving returns, that is specifically about cross-sectional returns. And second is to understand how the aggregate risk premium of asset classes behave. And now all the strategies are derivations of these two research themes. So you can derive reversal strategies, you can derive sector rotation kind of strategies or risk on risk off kind of strategies. But in essence, if you look at the notion of trying to measure the risk premium is a prediction problem, because you want to understand what is the conditional expectation of a future realized return. And with the advent of digitization in the value chain of investment process and investment decision, it has added value in two ways that some of which Marie have already touched upon. And if I have to just look at from the strategic perspective, it has given it has given us new data to look at, and it has given us new ways to engage with the data sets. So these two categories or these two elements have significantly contributed in all the aspects of for all the asset classes. Natural language processing definitely falls under the category of new information, converting unstructured data sets to structured data sets. And that definitely helps all our bottom-up fundamental analysts, not only on the equity side, but also if somebody is doing top-down macro analysis. You can easily convert, now quantify either the Fed minutes and evaluate the sentiment of Fed and see how it connects to the Treasury bond yield changes. Or you can look at earning transcripts to see how companies are talking about a specific element within their company. So there are many applications, not just in the equity, but also on different asset classes.
Thank you very much. Let me go back to Daniel. You mentioned before the way you use it at BlackRock. So maybe you can tell us a little bit and give us an example of how you're currently using artificial intelligence in your daily job.
Of course, happy to do so. And as this is an ICMA event, I thought I'd use a bond example rather than an equity example. It also highlights Prasenjit's previous point that, yes, we might be further down the road with equities or have more experience, but it's really not an equities only story. To a certain degree, it's a data story where is there data available. So if I look at our own uses within trading, so I run parts of our trading desk, for example. If I look at how do we in real life use AI applications at the moment, well, one application is when we trade bonds, we have to decide how best to execute. And some bonds you might have to execute voice trade, search for liquidity, speak to brokers. Others, they're more standardized, there's more liquidity. So you might use electronic tools to be as efficient as possible. And we have built a model in that context, which we call our liquidity score. And that model helps us with this decision-making and with this execution workflow. Now, in simple terms, first step, we need to understand the liquidity of a bond. So that's kind of where the liquidity score comes in. The model itself consists of various components or so-called features that help explain our model output. We look at the bid-ask spread of a bond, we'll look at the volume data that is available, we'll look at price feeds. Now, prices themselves in bond markets are not necessarily that easily available. So the price itself is built on a model that then goes into our liquidity score. We look at the similarity of a bond to other bonds and many further features. Order imbalance, Marie mentioned. So basically features that kind of describe the universe in which we're trading. And then with all of those features, we combine them into the liquidity score. And that's really where the machine learning, AI magic happens, that it can kind of in a fairly unstructured kind of learning way combine all of these things to make the best forecast of bond liquidity. So that in essence is the actual model. Now we use that model output to then additionally with technology auto route a bond either to a high touch trader or to a low touch desk. So taking a step back, I think that's a fairly typical application of an AI model for the industry. You've got a model, that model itself takes data and takes other models into it, and then it's used or combined with technology to make the workflows more efficient. And what stands out to me here is that the AI application, it's not this one big, huge standalone application that's all of a sudden displaced all of our traders. That's not how it works in reality. It's actually more something that sits within existing investment and trading processes, and in my case, within the trading world. And I think of it as complementing the existing workflows and the existing processes. So it's kind of, it is a tool that helps the trader. A further point I'd kind of make that I think is very important is we use AI in this example to make forecasts of liquidity, to kind of be fancy about that. However, it doesn't mean that there's no oversight over it. So all of this happens within a governance framework where it might be less intuitive to understand what the model is doing under the hood, under the bonnet. However, we can still look at the outcomes and we still assess this within the context of, does this meet our expectations after we've done all of our trades? How has this helped us with execution quality? So having an AI model doesn't mean surrendering all decision power. It's actually very important, I think, that where we use them in trading, that they are still embedded in a good governance and an oversight model. Now, then also asking the question, what's the benefit of all of this? Well, the benefit of all of this is we've got more accurate forecasts of liquidity. By having more accurate forecasts of liquidity, we choose the optimal way of executing, and by doing so, we bring costs down for investors. So bottom line, this is good for investors. We can reduce costs for them. So clearly beneficial in that sense, and clearly very additive to the investment process. Now, that's a trading example. There are many other examples, but I'd like to think that if we extend to maybe kind of the investment processes, portfolio managers, the whole logic is very similar when you're forecasting returns or when you're using AI in other investment contexts, that it is a tool set that helps complement existing processes. And we should really kind of always remember the benefit of doing all of this is we want to become better investors. We want to do a better job for our clients. It's something that helps us with that. We're not doing AI for the sake of AI. We're doing AI to become better investors. And that's kind of how I think of it. And liquidity scores are one example that has been very successful for us as a firm.
Thank you very much, Daniel. Before I turn to Mary on the robot advisor, which is another dimension of this debate, let me ask Jet about, do you agree, Jet, on this balance between human and machine? I think that's exactly what Daniel was alluding to. And maybe you can also mention something about your experience with a concrete example. And if I can further expand, so this means where should the investment go in the AI world across the asset management industry? Is it about machine? Is it about better integration of machine with human? I mean, it would be great to expand on what Daniel just mentioned.
Yeah, thanks, Max. Yeah, I do agree with the proverbial hammer analogy that we indeed should look it as a tool. And with any tool, thing what goes is that it should make our life easier, make our experience better, but it should also help us to think about different kind of challenges and problems so that we can eventually evolve as a person, or evolve the process in which we are engaged with. So within that aspect, AI and machine learning are an important tool, but it is even more powerful in tandem, in balance with the humans. So within this partnership, you can have, and again, in a broad sense, two kind of setup where humans are assisting the machine to build out, to sharp out new insights, and another, the machine is assisting the humans. So one of the contexts would be within this element, how you can navigate through high dimensional data spaces. How do you identify the new features from unstructured data sets? That is what the machine is assisting the humans. And when you are talking about humans assisting the machines, you help the machine to learn some of the patterns which only comes through experience. Because we have witnessed many events in our lifetime which have been unprecedented, and that neither big data nor machine learning algorithms can capture. So within NNIP specifically, we have specific usage of AI and also data, as Daniel mentioned, because it is also to some extent, to large extent, a data story as well. So specifically within NNIP, our adaptive investing equity team has been using AI to generate artificial stock markets to research the market behavior in the simulated environment. So that gives our portfolio managers and researchers a good insight on how the market might behave in future, and that helps them position their help them in bet sizing or position their industry groups or stocks accordingly. Within the multi-asset space, we have been using specifically data derived from social media and news media, convert them into different dimensions of emotion, not just the blanket sentiment, but also what is the specific anger index or optimism index or anger on government or political risk index. So that in conjunction with the traditional indicators have greatly enhanced our market timing and tactical asset allocation models. So there are, like Daniel also mentioned, there are many applications, but net, it has potential to help investors to look at new information, but also use older information in the new ways. that really augments the entire investment process value chain.
Thank you very much, Jet. So better service for clients in terms of can help to create more alpha for clients?
Sorry, we didn't hear your question, Max.
Yeah.
My apology. I was wondering if you say better portfolio management. So I was wondering, do you think AI can help to generate more alpha for clients?
Well, that's a difficult question to answer because when we talk about alpha generation, we have to also put many things into context, meaning on what time horizon are we talking about, which market are we talking about, and which asset class we're talking about. So in general, there are mixed evidences that over engineering does not help, and sometimes linear models are much better in performance as compared to the sophisticated nonlinear methodologies. But there are also use cases where instead of using AI for modeling, you use AI to identify new sources of alpha and then plug it into a simple model. Then you see a better, you see improvement in performance using traditional performance matrices or 1 year or 3 year rolling Sharpe ratios or information coefficients. But there is no blanket absolute truth that if you use AI, you will definitely have alpha generation capabilities.
Thank you for the candid answer. And I hope you can hear me well. Apology about the quality, but I'm not sure I'm succeeding always. Let me turn to Mary on the other side of the story, which is the client relationship side of it. I mean, Rob, but the big question is, to what extent retail and turning to this type of solution so far?
Yeah, so the robo-advising space is a very interesting application of AI, even if we come back to Daniel's classification that the narrow version of AI, because there are no complex algorithms used that much today in robo-advice. So they rely typically on simple portfolio optimization tools, typically very classical Markowitz or Black-Litterman optimizers, mechanical automation, for example, automatic rebalancing. So it's quite rare that we see fancy techniques used in the robo-advising space. But it's still some AI because it relies on automation, it relies on algorithm, even if simple, and at various stages of the process. So first to profile the clients, because there is a profiling and scoring methodology, then to define an optimal asset allocation, and then to optimally rebalance, so design a strategy that will optimally rebalance, or allow to do some tax harvesting, that kind of thing. So I think there is one question, which is why isn't there more machine learning or artificial intelligence techniques used in robo-advising? One answer is probably the client's trust in technology. Here I quote, there was a nice CBS survey on the trust in technology of clients. And for example, only 8% of the respondents say they would trust a robot programmed by experts to offer mortgage advice, while 41% would trust a mortgage broker. It was 19% for robo-advisors, but to be compared with 9% that would be likely to use a horoscope to guide investment choices. So we have to be very careful with the trust in the technology. There is algorithm aversion, so not every client is ready to use robo-advice, ready to rely on an algorithm to get guided choices. Another related question is also the debate, especially in the US, on the fiduciary duty of the robo-advisor. Typically, it should disclose algorithm possible limitations. And of course, if you use a more sophisticated algorithm, that is also more complex to disclose and bring full transparency. But one area where I think that there are very promising developments going on is the question of human-robo interaction. So first, how to generate trust in the algorithm. So we've seen that it's not that you shouldn't take it for granted. It can be built. How can you build that? There are a lot of experiments made in other spaces, for example, on automated vehicles, etc. And what is shown in these spaces is if you bring people back some power on the algorithm, so make them the ultimate chooser, the ultimate decision maker, they are more confident in the algorithm. So that's something. And that's very important for robo-advice because there are basically two types of robo-advisors. The one that are fully automating, so you accept the service and then you're automatically rebalanced. So it's all automated. And the ones that choose to give people power. So you need to decide, you need to say if you agree to accept the rebalancing that is proposed, that is advised by the robo. So it may be that bringing people's as decision makers may have some value added, and that's something that should be more researched because that's probably a very interesting space. So how to generate trust, how to design an efficient interaction between the human and the robot, how much explainability you should have for the algorithm is also very important. Full transparency probably not needed, even for a simple algorithm. So do you need to know all expected return, how you shrink the covariance matrix? I mean, some robo-advisors provide all this information on their website, but how many clients are able to understand what is behind a portfolio optimizer? So it's not full transparency that is needed. It's more explainability of the process, understand the limitation of the algorithm. And on that, again, I think much more should be developed. We are really in the infancy. And you asked about the impact on the clients. So are people taking these services? Yes, not everyone. Young people are more prone to do that. Male rather than female are also more prone to accept these kind of services. What we found, because we studied the impact of the introduction of a robo-advisor on employee savings plan at Amundi, on a very large scale of clients, also clients that are non-educated, because there are people working in the private sector very generally, so a very broad base of clients. And we found a very large impact of introducing the robo-advisor. If you're interested, the paper is on the website. We found that it increased saving, it increased a lot risk-taking. In average, 7% more equity exposure relative to a 15% at the baseline. So it's a 50% relative increase. So it's quite large. People pay more attention to their plans after being advised. So there are also large impacts on the behavior. And importantly, a very last point, it has an impact on financial inclusion. And I think that's something which is very important. Robo-advisors are reducing the fees. They are reducing the minimum amount to invest very frequently. And what we found also in your experiment is that it has a larger impact for the more modest or the clients, so the one having a lower income or lower assets in their plan. So these people increase more their equity exposures, they benefit more also from return improvement. So that's something that should also deserve more attention. How much does robo-advising allow to serve people that were underserved by the traditional client advice, and how much improvement do they get in their savings and investment decisions?
Thank you very much, Mary. Would you say it's more a retail story rather than institutional?
I don't know. It could be both. I mean, the developments we've seen more are on the retail space, but you could imagine also to see that kind of service. Or, I mean, what we see is two different things. We see robo-advice in the B2C, what I just described, but also B2B for distribution networks. So that is also very widely used. But for institutional investors, you could also see the development of other forms of advice that could make a lot of value added. Of course, much more sophisticated types of advice, but I think that would also make sense. Huh?
I think that's absolutely correct. Also from our side, the UBS, we have basically we see the creation of a digital environment where the client and the
We lost you.
The use of this platform from both parts can become very powerful, and then of course AI can act as a facilitator of that digital interaction. Let me now move, also in the interest of time, to the challenge and the opportunities which AI creates. And maybe let me come back to Jet by really focusing on the risk in the deployment of AI. I mean, I don't use the word black box, but let's say opacity or complexity or any other issue that you see eventually arising from the more widespread application of AI, and eventually what already you're doing to mitigate that risk.
Yeah, I think first of all, I think Murray made a lot of terrific points, and some of them are also quite relevant in our context. In terms of risks, I think the risk and challenge starts even before we deploy the AI. So if I look from the lens of suitability and usability, the first challenge is not technical, it's more strategic, that we have so many already open source AI tools and models available, but where do we start? Should we start throwing data, compute power, and AI to all kinds of problems? Will that work? So within that, it's very important to first start with the decision context, working closely with your the investors to understand what kind of problems they need to solve. So once that strategic thing is aligned, then you can move on to the second challenge of what we described, what kind of models we're going to use. And I think this notion of opacity or black box is quite subjective, because, for example, if I ask my data scientists, for them, the neural network model is not a black box. They can easily explain. But if I go to some other colleague, then if I have to explain how correlation works, they will say, this is too complicated for me to understand. Can we do something simple? So it really depends. But for the sake of argument, let's use complexity. The inability to comprehend could be a challenge, but it really depends whom are you explaining it to, and how that other person is going to use the output. If it is really an application of, let's say, natural language processing, then they do not need to understand the inner workings. You present the output in a nice graphical user interface where they're able to interact and learn how the model works. And then testing becomes a basis of trust. And then that's how it works. It's a complicated problem, but it is solvable. So within the domain of complicated systems, trust can be achieved using testing. But when you're talking about complex and adaptive systems, there is no rule. No amount of compute power and mathematical reductionism can solve it. Then you need to adopt what Murray also touched upon, how you can solve algorithm aversion. So the way we do it, we involve the humans earlier in the loop. In the feature engineering space, we ask them, can you provide the model inputs? So we don't want to rely entirely on the models to give select the variables, identify the variables. You give the model inputs based on your experience and interaction in the market. So they provide that. Then we use a model based on the context. And then instead of spitting out point estimates, we provide a bit more comprehensive output, like a scorecard or point estimate with some information how it worked in different environments. And then finally, which Murray also touched upon, empower them, which means you give them flexibility to change the outcome. That gives them a feeling that they are under control. And that way you are able to mitigate the algorithm aversion, because if they are not adopting or engaging with the machine output, it doesn't matter how good your machine learning or AI algorithm is, there would be no usability. So from the context of suitability, lens of suitability and usability, first it's important to align on the strategic level, then understand what is the decision context and whom you are explaining, and then reorient your outputs accordingly so that the user is actually using your outputs.
Thank you, Jet. On that topic, I have a question that maybe I would like to ask to Daniel before I go back to Mary, which the question is, of course, is about execution. To what extent is AI being used for the execution? So how do you address the risk of convergence in trading, which can increase the volatility in the market? I think it is a question about the link between quant strategy and volatility in the market. There has been already a long debate about that.
Apologies, could you repeat the question in one sentence?
I'm very sorry. It is about the use of AI in the execution of trading, if there creates a risk of increased volatility.
I suppose it depends, but I don't necessarily think so. I mean, it depends on the actual use of AI, as in, if I go back to my example of liquidity scores, you're just using AI to make cleverer decisions, but there's nothing in that is actually leading to more volatility, or that even has the potential to lead to more volatility. There are, I suppose, kind of potential areas, if you thought about the investment the wider investment community, the similar models might lead to similar behaviors and might, as a result, increase volatility. But arguably, that's a risk that existed even before we had AI tools. So it's not necessarily that there's nothing that would systematically, in my opinion, increase volatility, but it's important that the user uses a tool sensibly, whether that's an AI tool or whether that's any other tool, of course.
Thanks, Daniel. And I would like to turn to Mary about the question of the fragmentation, which is also about the use of data. I was actually surprised. I was not surprised to hear from the European Commission as well. He talked about that at length. So what is this risk, particularly in the use of data from external providers as well?
Yes, thank you, Max, for this question. I have to say that this is something I have been extensively discussed with ESMA, because I'm part of the Financial Innovation Standing Committee, and they have been required by the European Commission to bring advice together with EBA and EIOPA on this question. So this is something we have been discussing together. Yes, there is a risk of value chain fragmentation if you think about asset managers delegating part of their process to third parties. And in particular, one aspect which is particularly important is the fact that you might delegate it to an unregulated institution that is not in the scope of ESMA, EBA, or EIOPA. So that's something that should be probably closely looked at. And asset managers themselves do not feel so always very comfortable with that. Another thing is a loss of transparency. Typically, if you use a so-called black box algorithm, even if we're not allowed to say black box, risk of manipulation as well. If you think about the risk of piracy, data piracy, but also algorithm. And that's related to the cybersecurity risk. And another thing that Matthias Levin touched in his very interesting speech just before is also the question of data sovereignty. There is this Cloud Act in the US, so the US administration can require access to the data to any US cloud provider. And that's something that European asset managers also fear as a potential threat. So there is a clear need to create a European financial data space that would be secured, and there is really scope for improvement in that space. So yeah, there is a risk of maybe value chain fragmentation that should be monitored and probably addressed in the coming months.
Let me turn to the opportunities. We have a really few minutes left. I mean, we heard about better portfolio management, example about liquidity, data augmentation. We also client experience. There are more opportunities that you see. I give you some hints. For instance, there is a lot of talk between the link between ESG, sustainability, and the use of AI. And anyone, please, can jump on this because I think it is a very interesting topic.
Yeah, perhaps I can add a few cents on it, given we are overshooting the time. So the main context within the ESG context, ESG landscape is that most of the asset managers are striving hard to do ESG integration. And in that, if you really want, within that context, if you want to become an ESG leader, in turn, you have to become a data and analytics leader, because the data sets within the ESG space are many providers and with different methodologies. So that already creates a lot of confusion. Thereafter, not all asset classes are created equal, so you do not have full coverage. So within NNIP, just to give two quick examples, within our European equity team, we have been leveraging upon NLP to understand how the corporate tones have shifted during the COVID-19 pandemic. And one of the insights was what we got from the quantifying the text analysis was that a lot of companies were talking less about the earnings related topics like growth or gross margin or earnings, and they shifted their conversation more toward the social aspect. So that helped our investor to profile the corporates accordingly using this insight. They further went one step ahead and also created an index of corporate culture and understood how the corporate culture is evolving based on certain seed words and keywords from these earning transcripts. So that was a beautiful example of how investors can leverage upon AI and these unstructured data sets to boost their ESG agenda. The second example was what we did within our investment science team was to use an encoder-decoder architecture, a neural network architecture to fill the missing value within the ESG data space. That really helped us to broaden our coverage of asset classes for our emerging market investors, thereby helping them not only improve their corporate valuation, but also use the scores and indicators more in a systematic manner. Well, the more information is available in terms of the materials which would be shown within the event. I encourage you all and also the members to have a read, and if you have any questions, reach back to us on that.
Thanks. Anyone on this topic wants to add something? Mary?
Yes, maybe on the benefits, two quick words. I see two main benefits. So I think technology is democratizing access to wealth management. That's certainly something very important. We discussed that with Robo advising. And also another benefit is that alternative data can improve informational efficiency. I think that the use of more data and to integrate it in a better way with these new algorithms is able, and it has been demonstrated by academic research that it improves market efficiency. So that's also probably a positive impact in general.
Thank you very much. We are very close to the end of the panel. I would like to ask each of you in 30 seconds to really address the last topic of the panel, which is about the impact on the industry from a business perspective, because there is always a lot of talking of how disruptive is digitization for the financial service industry. According to some, we are on the verge of a revolution. According to others, actually, for a lot of different reasons, this is not the case. I mean, look, in the light of the debate that we had during this webinar, including the question of course, the digital assets, what do you think is going to be the impact on the industry going forward? And most important, are we going to be all replaced by Google and the tech companies down the road? And really, if you can stick to really a very short answer each, and then I will pass the floor back to Bob. You can start with Daniel.
Yeah, happy to go first. Look, I think as my fellow panelists have said, the opportunities are huge. So this is a huge opportunity for the industry. I don't think that we're all going to be replaced. However, I do think that there is going to be a shift in skill set needed from kind of each and all of us. And that journey has started. That journey started 10 years ago after the financial crisis. And that journey is just going to continue more and more. So kind of traders today, portfolio managers today look different from the way they looked 15 years ago. And that's something that we should all embrace. I'm a big believer in it. And I'm a big believer in the opportunity and the benefits for our clients and for the European investors in general. So kind of let's not see it as a threat, let's embrace it as a massive opportunity that can do good for all of us.
Thank you. Jet?
Yeah, definitely agree with the opportunity argument. The opportunity comes in terms of flexibility, definitely, but with greater flexibility comes the need for better disciplined approach. And if you don't do that, the benefits from the Moore's law can be quickly offsetted by the cost of the Murphy's law, which says things which can go wrong would go wrong. And to your earlier question, will all these techies dive into financial services? I think not, because there are a lot of regulatory pressures. What they would do is partner with big banks, like Google already did with Citibank. They opened I think it's called a Plex checking account. Now they are now they have embedded themselves within the financial services industry, and within a partnership model, I think this techies can have a big power to disrupt the landscape.
Thank you, Jet. And finally, Mary.
Yes, I would generally agree on the opportunities, as Daniel and President have mentioned. But I think that more generally, digitalization is changing the nature of intermediation. And on that, maybe there is a threat on asset managers. So I think the main disruption will probably come from the way funds are distributed to clients, with less reliance on banking networks. So we see that with the development of robo-advisors, and we discussed that extensively, but we see that also with the development of fund distribution platforms that now serve as intermediary between banking distribution networks or institutional investors and asset managers. And these fund distribution platforms are in an oligopolistic position, and they are now imposing their conditions to asset managers on the fee structure, etc. And if you look at other industries, the same kind of disruption brought by platform happened as well. I think about tourism, etc. So I think that's the point where we should be particularly careful. Another point I'd like to mention is that data is an asset today, and it will favor some actors. And if you think about how the asset management industry is organized, it will favor big players, because big players are able to collect comprehensive information on clients, and they will have a comparative advantage. So for example, players like BlackRock offering services like risk management or operating trades, what we are doing, all that is allowing these asset managers to collect information and make them in a more dominant position. So what about big techs? They are already present in the payment space, and they could naturally develop their activity in the fund distribution business. They do it already in China. Maybe, as President said, by partnering with banks, maybe not. So I think it's a big open question.
Thank you very much, Mary. I like the word you use, a competitive advantage, because I believe this is really encapsulate the spirit of this debate. AI, it is a source of competitive advantage for asset management firms, either in the portfolio management side, in the client relationship side, in the distribution of products. So I really believe that AMIC will continue focusing its attention on this topic. And with that, I'm very sorry, Bob, but we used the word black box a few times, but I hope that it didn't come out as a black box, and we open it a little bit, and we put a little bit of light into it. So I give you back to Robert, but of course, let me thank you, the three panelists, because I think you have been great. Thank you very much, and Bob, back to you.
Thank you.
Max, thank you very much indeed. We've run slightly over, but we've tried to be disciplined in time, but obviously we've now sort of run out of time. I'd like to thank Matthias from the European Commission, Arthur and Max for chairing the panelists, and obviously all the very strong and positive contributions from the panelists. And I hope that we've achieved a clear explanation of what we think are the trends and the important issues in digitalization, whether it's tokenization, whether it's AI. Can I encourage everybody to complete the feedback forms, and there is a survey that will open shortly in your browsers. And on that point, I think that this subject is not going to go away. If anything, I think the discussion about digitalization is going to become more profound. And with my colleagues, we'll certainly discuss having an updated webinar on this subject and related subjects later in the year. So thank you very much, and everybody have a good day. Thank you.